in and out of the markets will require you to have a proper understanding of market orders. So in today's topic, we are going to study the type of market orders. All right. Yes. So in your Forex journey, you will come across different types of market orders. All right. So we are going to look at the type of market orders. So at number 1, we have market orders. Okay. At number 2, we have limit orders. All right. We have limits orders. At number 3, we have, yes, stop orders. Stop orders. At number 4, yes, stop loss orders. Stop loss orders. At number 5, trailing stop orders. Okay, they are part of the stop loss orders. Trailing stop orders. All right. So a trader can use any of these orders to manage risk and automate their trading strategies. What do I mean by automating your trading strategies? For example, using a trailing stop loss order. For example, you get a good buy trade in an uptrend and you really want to take advantage of the whole trend. You would want to use a trailing stop orders so that you may take full advantage of the good. So just to look at the market orders, they execute immediately, all right, at the current market price, all right, while the limit orders and stop loss orders are used to specify desired entries or exit prices when it comes to, okay, the market. Okay. While the stop loss limit orders, these combine both elements of both the stop and the limit orders. All right? Can I repeat that? I said that the market orders execute immediately at the current market price. All right? This is at the current market price, while the limit orders are used, okay, while the limits and the stop loss orders are used at specific and desired entry and exit prices. Okay, so these ones, they have specific entry and exit price levels. Okay, while the stop loss orders, they combine both the stop and the limit orders. All right, so let us start with the elephant in the room, which is the market orders. All right, so we will rub this, of which we will study them later on and focus on market orders. We said that it is at the current market price. All right, so the two types of market orders, we have instant buy and instant sales. All right, at the current market price. Is that all right? Any question? No question. All right, so as I said earlier, market orders, these are type of orders that are executed immediately at the best available price. All right, so this, you give your broker orders to execute immediately at the best available price. Okay, so they are used when speed execution is a priority, and when the trader is willing to accept the current market price. All right? So we've said we have immediate, immediate execution. All right? Immediate execution, and the trader must be willing to take the current market price, and he must accept the spread at that current market price. All right? So there are advantages and disadvantages of trading the markets at the current market price using market orders, the instant buys and the instant sells. So the advantage is that you are guaranteed to enter the trade at the best available market price. So the first advantage is that there is guaranteed entry. All right? Good. What about the disadvantage? The cons. All right? The disadvantage. The disadvantage is that you might get slippage. All right? Using instant buys and instant sells, you might get slippage, especially during fast moving markets events, especially during real news release and fundamentals. Okay? So here you might get what? Slippage. All right? Slippage. Okay? So what is slippage? Slippage is if you wanted to buy at this price, okay, you placed an instant buy at this price, and then the best available price in the market at that time during this news event is here. Due to what? Whatever is found here, this is what we call slippage. All right? Okay, so this is the disadvantage of using instant buys and instant sells, especially during fast moving markets, especially during news events. All right? Any question about this before we move to limit orders? No question? Good. So at number 2, we are going to discuss limit orders. All right? We are going to discuss limit orders. At number 2, what are limit orders? Okay, so these types of orders, they specify a desired price for buying and selling. So they specify where to buy and where to sell. Okay, there are 2 types of limit orders. Which are those 2 types of limit orders? 1, buy limits. There is buy limits, and 2, sell limits. Okay, we are going to discuss them and see how different they are from each other. Okay, so this type of orders, the buy limit and the sell limits, they can only be executed if the market reaches that specified level. Okay, they can only be executed if the market reaches that specified level. Okay? Good. So we are going to start with the buy limits. What about the buy limits? We are going to start with the buy limit. So the buy limits, these are orders that are set at a maximum price to buy. All right? What did I say? Please note this. These are orders set, all right, at a maximum price to buy. All right? Good. What about the sell limit? These are orders that are set at a minimum price to sell. Orders to set a minimum price to sell. Good. Is that clear? Yeah. Good. So when it comes to buy limit, these type of orders are executed excuse me. These types of orders are executed if the market price falls to or below the limit price. I'll give you an example. So if these are only executed when the market price falls at or below the limit price. Please note, this is very important. They are only executed when the market falls at or below the limit price. All right? What about the sell limit? The inverse is correct. They are only executed if the market rises to or above the limit price. All right? They are executed when the market price rises to or above the limit price. You are very spot on when it comes to that. Okay, so I'm going to do a very small illustration on buy limit and sell limit. We'll start with the buy limit. All right, so let us say that our current price is there. All right, where do we set our buy limits? Our buy limit, we set it at a place like this. All right, so this one is our current price. All right, so we expect the market to come tap to that price, make us to enter the market, and then boom, we get into our buys. All right, so this is our buy limit order. All right, good. This is our buy limit orders. So it gives the market the orders to buy below a specified period. All right, is this clear? We said that they are executed when the market falls. When the market falls at or below the limit price. Okay, so let us illustrate what is a sell limit. So in this example, you'll find that our current price is around here. Okay, so this is our current market price. All right, and we will put our sell limit there. Okay, so we'll find the sell limit price order here. All right, so the market is executed when the price rises to or above the limit price. So it can only be executed when the price will come at around there. It get executed or triggered, and boom, we get our sales. All right, so these types of orders, they are orders to sell above a specified price. Okay, so it will sell when the price will get here. All right, so I want you to copy this. This is very important. Buy limit order and a sell.
For example,
yes,
if the price,
yes,
you have said the sell limit,
mm-hmm.
the price, okay, the current price is there.
Mm-hmm.
So it means that it will buy.
Okay.
Then when it reaches at a certain point,
yeah,
where you have put your sell limit order,
yeah,
then automatically it gets activated.
Sure. So So this is like a trap that you've set in the market. All right, and this happens when there are reversals. All right, or when this one is a supply zone. Okay, so if this is your current price, all right, you set a sell limit order that when price will come to that level of your price, it will tap it, get triggered, it will get yeah, so you get in the market, okay, and then you start now selling with the market. Okay, so ideally your TP will be around this area, all right, and your stop loss orders will be around these areas, all right, and in this case your stop loss will be around this area and your take profit around that area. Is that clear? Okay, good. So we have advantages and disadvantages of using buy limits and sell limit orders. Okay, so the advantage here is that you can buy and sell at the price you want. Remember, this is the price that you yourself you've set. All right, this is not the market orders where you instantly buy or sell. You buy and sell, you buy and sell at the price that you want. All right, this is the advantage. You get the power to decide. All right, good. Sorry about that. What about the disadvantage? The disadvantage, the pros and cons. This is the cons. All right, okay. The disadvantage is that you might not get filled on the trade. Okay, getting filled now becomes an issue here. Okay, imagine the price comes, it comes to your price, all right, it comes like this, like this, like this, but it does not fill you in because your order were here. Okay, it does not fill you in and then it starts selling. All right, so in this case you are not filled. When you come to your chart, this will pain you and it will really affect your psychology if you are not so strong in the markets. Okay, so the disadvantage is that you may not get filled. Okay, but in any case that you watch the market come to here and you notice the market now, it's like it will not fill this price, you can use a direct sell, instant sell market order to get into that trade. Okay, in this case the market can come like this up to here, it does not trigger you in and it starts to rally. Okay, here it starts to drop. All right, I hope you've understood that correctly. Any question before we go to the market stop orders? Any question? No question? Okay, it's clear. Anybody who's not finished copying this? Okay, so number 3, we are going now to the market stop orders. All right, we are going to discuss now the stop orders. We've just looked at the limit orders. Please get the difference between this type of orders. You will be using them on a daily basis. They are what gets you in and out of the market, and you will use them to automate and refine your trading strategies. Okay, so at number 3, we are going to look at stop orders. What are stop orders? Okay, stop orders are often used for risk management. Okay, this helps us to enter a trade after a price breaks out. Okay, so stop loss orders, they help us in risk management. Okay, 2, they help us to trade price break out. Okay, that is their two most significant. There are two advantages of stop orders. We have two types of stop orders. Okay, the first one is buy stop. Okay, buy stop. The second one is sell stop. We are going to look at these two separately and define what they are and even illustrate them. All right, so we will do as we did on the other. So what is a buy stop? A buy stop, these are orders that are set. Okay, these orders, they set prices above the current market price. All right, so these orders, they set a price above the current market price. All right, and the orders trigger when the price increases to the stop price or higher. All right, so what am I saying? These orders, they set price above the market price. All right, what about the sell stop orders? They set the market below the current market price. They are the exact opposite. They set the price below the market price. Is that correct? Good. So these orders, they only trigger when the market increases to the stop price. Okay, they only trigger when the market price rises to the stop order. Okay, the inverse is true. This only triggers when the market price falls to the stop order. Okay, good. Is that clear?
Yes.
I'm going to illustrate with a diagram. Okay, I'm going to illustrate here what happens on a buy stop. Okay, let us say that our current price is there. All right, so where do we place our buy stop? Here. All right, our buy stop is there. So what happens is that it can only be triggered when the market price rises to the stop order. Okay, so when the market prices rises to the stop orders, it triggers it. Okay, it triggers your order, gets you in the trade, and decides to move. Okay, you can move like that, and like that. All right, so ideally this is how a buy stop order will look in your markets conditions. Okay, what about a sell stop order? A sell stop order, we have, it is the inverse opposite. We have our current price. We have our current price there. Okay, we'll have our sell stop order there. Okay, what does the price has to do? It only triggers when the market falls to the what?
The stop order.
To the stop order. We have our order here. Okay, and what happens? The price will get triggered. It gets us into the trade. It does like this, and then it falls. All right, so it gets us into the market and we continue selling. All right, is there any question about this before we look at the pros and the cons of using buy stop orders and sell stop orders? Any questions? Now let us look at the pros, okay, the advantages. The advantage is that they are used in breakout trading. All right, they are used in breakout trading. Let us say, for an instance, that you had a resistance line here. All right, so you will set your buy stop order above the resistance price. All right, so when the market comes here, it breaks out, it gets and triggers you into the trade, and you continue buying with a trend. All right, in this case you have your support here. All right, so you will place your sell stop order just some few pips below the support zone. All right, it will trigger you into the market and continue selling. All right, so it is used in breakout trading. What about the disadvantage of such type of orders? Is that it might be a false breakout. All right, so most of the time these kind of trades, they get you in a false breakout. All right, have you understood up to here? Okay, good. So we are flowing well. Okay, so copy this before we move to the fourth type of orders, which we said they are stop loss orders. And finally, we look at the trailing stop orders. All right, fourth type of market order of orders in the market are stop loss orders. Okay, so if you're done with this, we will rub and look at the stop loss orders. Okay, so let us rub this and look at stop loss orders. What are they? They are used in risk management. Okay, they're important, really important when trading. Now this one are called stop loss orders. It is number 4. So how do we define them, or how do we use them? A stop loss order is used to limit potential losses by closing a position when the price moves against the market. Okay, so basically this is your safety net. All right, yeah. So let us take an example that we have a buy trade. Okay, we have a buy trade. You decide to enter the market at that point, so you buy here. Okay, where do we put our stop loss? Our stop loss, we put it below here. Okay, so this one is our stop loss order. Okay, in this case we may take a stop loss order of around, let's say, 20 pips. Okay, let us take a stop loss order of around 20 pips. Remember, this was a buy trade. Okay, so if the market moves in our favor, it will go like this. It will go like this, maybe. All right, so where is our take profit? Up there. Our TP is there. If you use a risk to reward ratio of 1 to 2, this will be around 40 pips. All right, so we are buying low. All right, and we are selling high in the case of sales. All right, yes. So our stop loss order is here. It is used to limit our potential losses. All right, good. So let us take an example on the other side of a sell trade. Okay, and we decide to sell here. All right, we are shorting the market from here. Where would be our stop loss order? Up here. All right. So this is our stop loss order. Okay. Let us take our 20 pips. 20 pips stop loss. All right. And the market decides to fall like this. Okay. Yes. So where is our TP? Down here. All right. So this is our TP. In this case, we take a 1 to 3. A 1 to 3 risk to reward ratio. Our stop loss will be 20 pips times 3, 60 pips reward. All right. Any question about that?
Understood.
Clear, right? Good. So let us look at the advantages and disadvantages of using stop loss orders. All right. So on the advantage is that our stop loss orders, they will protect your account against deep drawdowns and deep losses. All right.
Yes.
So this one is to protect your account. All right. What about the disadvantage? Using tight stop losses, you might get stopped out prematurely. Okay. So if you use tight stop losses, SL for stop losses, you might prematurely, you might get stopped out, and then the trade moves to your favor, to your desired direction. Okay. So if you placed your stop around here and the market decided to come this way and then this way, you will get prematurely stopped out. All right. So it is very important to put breathable stop losses so that you may give your trades some time to breathe. All right. Yes. So you will find some traders using the word stop hands. Okay. For premature for premature stopped out trades, you may find some traders using the word stop hands. This is where retail traders feel like the institutional traders are stopping them out first before the trades move to their desired directions. Okay. But it is really important to trade with a stop loss. All right. You'll hear traders, for example, these guys who love flipping accounts saying that the stop loss, their stop loss is a zero balance account. But please, if you want proper risk management, please always use a stop loss. All right. And you must be willing to accept the outcomes of a trade for you to set a stop loss. Okay. So please note this down before we go to our last type of orders, which we said were trailing stop orders. Any question on stop loss orders? This one we are going to delve deeper because it is really important on our subsequent classes, and I'll show you how professionals uses the ATR to measure their stop loss orders. Okay. Yes. So we wrap this and look at the trailing stop orders. All right. At number 5 we have number 5, trailing stop orders. What are trailing stop orders? It comes from the word trailing. All right. So these are stop loss orders that automatically they adjust themselves. Okay. And they stop the price as the market moves in the trade's favor. All right, so they automatically moves with the price, and they will stop you when the market tries to reverse on you. All right, so I will illustrate. Okay, so let's take an example that we had a buy trade here. Okay, buy trade there. Okay, we had set our initial stop loss at around here. Okay, the market decides to do this, and it is rallying above. Okay, so what a trailing stop does, it automatically shifts your stop loss order to, let's say, here above your entry. Okay, so this is our stop loss 1. Okay, this type of stop losses are used in trending markets, highly trending markets. Okay, so you put it some few pips below a higher low like this. Okay, when the market moves higher, it automatically adjusts your stop loss to the next higher low. All right, and subsequently you place your SL3 there. In any case that the market would want to reverse on you, it will trigger you out. Okay, and close you with this profits. Okay, because ideally there are times when the market will reverse, take your entry out, and even eat all your profits. Okay, yes, so I'm going to teach you how we use trailing stop orders in trending markets. Any question? We've certainly come to the end of our class today. Okay, and in our next class we are going to learn about pip value and how to correctly calculate the pip value. Okay, so see you then.